Welcome to this second video on exchange rates in NetSuite, which is part of our NetSuite refresher training number 4. Today we will look into transactions that are using foreign currencies. We will look first into foreign currencies in common transaction types. Then we will describe the function transfer funds. We'll explain what currency revaluation is as a specific type of transaction. We will look into gains and losses that are related to transmittal payments. And lastly, how to deal with realized exchange differences. So let's start with foreign currency in common transaction types, such as journal entries, donations, bills, invoices, transmittals, and expense reports. All of these transaction types can be entered in foreign currency. I will show you an example of a journal entry in foreign currency, but it works the same way for other transaction types. So here is a journal entry that has been entered in US dollars. You can see the currency here, which is not a base currency of this particular entity. You see the exchange rate. When you are entering the transaction, you cannot change the exchange rate here. You need to accept the exchange rate that is given in NetSuite for that particular date of the transaction. I can scroll down here and see the lines of the transactions that were entered in US dollars as a foreign currency, but I can go to GL Impact where I would see the same, but in the base currency of this entity calculated by the exchange rate that was given by NetSuite. Obviously, this GL Impact happened automatically. The transaction was entered like this in the exact amounts in US dollars. The second topic that we will look into is how to use the transfer funds function in foreign currencies. This is when we are moving money between two bank or cash accounts, and you can find it under transactions, bank, and transfer funds. It is important here to use the actual rate of the exchange, not the rate that NetSuite will give you, which I will demonstrate. Never do these transfers as journal entry, but always use this transfer funds function. Let's look into that. I'm finance leader, but I can do this with a bookkeeper role or accountant. I will go to transactions, bank, transfer funds, and this is a very easy screen to follow from account to account. So what I want to do is to exchange $5,000 into my base currency. I will choose the USD account. It shows me the actual balance as of right now, and I will move it to our main account that is in base currency. I can choose the date. I told you already that I want to exchange $5,000. Now, what happens here? There is an exchange rate given here by NetSuite. Based on that, NetSuite calculates what would be the amount in my base currency. But when I did this exchange in bank, I did not get this exchange rate. I got a lower rate, 108,400. So this was the actual amount that I got in the bank. So I entered that amount, and you can see that as I click somewhere else, the exchange rate adjusts. So in this way, I would have no exchange difference that is booked directly at this moment, and I don't need to handle any differences. It was 5,000 on the dollar account, and it was 108,400 on the base currency account. So the RC would be none because this is just a moving cash. I will save it. The next topic is currency revaluation as a specific transaction in NetSuite. Currency revaluation is adjusting a base currency balance on an open balance in foreign currency. I will explain that on a bill in foreign currency. There is this bill that was received on March 10 and was entered into NetSuite. It was for an amount of $1,000, which again is a foreign currency, at exchange rate of 0.85. That was the exchange rate in NetSuite for that day. And the base currency amount, therefore, was 850 euro, which is my base currency. It was credited to payable. Now, I paid the bill on March 20th, 10 days later. The amount was the same in dollars. It was still $1,000 that I was supposed to pay, but the rate changed in NetSuite. It was now 0.86. So the GL impact of this bill payment was 860. And I debited payable, or the system automatically by the bill payment, debited the payable account with 860. There is a difference of 10 euros on the debit side of this payable, and that's exactly what the currency revaluation handles. It will clear this difference of 10 euros from that payable. Because it's no longer a payable, it's actually an exchange loss that needs to be removed from this payable, as this payable was closed. Here is an example of currency revaluation. Let's start with the second line, that is clearing the difference on payable account. In this case, it was $4 because the bill was in a different currency. So it is clearing it from there, and it is debiting this account, gain-loss account. The loss in this case, it's realized because the balance of this payable account was closed. The payable has been paid. The responsibility center is known, which I will address later. This was done automatically by the system. Currency revaluation is a system transaction. So there is no manual calculations needed. The system does it automatically. You don't have to worry about that. And it is triggered by any of the three following processes. Either when you are closing an open balance, like for that bill, the bill was paid, and so the open balance of the payable was closed. In that case, it creates a realized exchange gain or loss. The other way how this can be triggered is a global month-end closing, and this creates unrealized exchange differences on currency revaluations. And the last one is that this can be triggered by you after you finish a month. You can run the currency revaluation process, and these currency revaluation transactions are created. And again, it is similar to global month-end closing process. It creates the unrealized exchange differences. Next topic is gain or loss related to transmittal payment. Transmittal payment is when funds are sent via bank or cash from area to a country. At that moment, the balance held by the area office for a specific country or entity is revaluated. And the exchange difference that is a result of this revaluation is booked on RCIT Clear. And it is realized exchange difference because this is actually moving funds from one currency to another. Let me show you an example. Here is an intercompany journal entry which was created as a result of a transmittal payment. This intercompany journal entry has many lines, but if you scroll down all the way down, the very last transaction has description gain, loss. It is booking exchange difference on the transmittal payment. In this case, it's a loss. It uses realized exchange difference, and it is booked on RCIT Clear. How to deal with realized exchange differences. Realized exchange differences get booked on several RCs. IT clear, like we just saw that the difference on the transmittal payment has been booked there. Some of the differences are booked on RC non, and occasionally some of the exchange differences, realized ones, get booked on Forex RC. The process for you is that you create a journal entry and move these realized exchange differences from these RCs to some entity-specific responsibility center or centers that should cover exchange gains and losses. Here is an example of how that can be done. We have already seen this transaction, so this was a currency revaluation, realized exchange loss in this case. That loss was debited to RC non, which is not exactly the best place where to put it. Therefore, there was a journal entry created that is moving it. So it is crediting RC non and it is debiting a country-specific responsibility center that is designed for this. You can notice that it is using the same account on both sides. And since this journal entry was actually clearing several transactions, it is not just this one currency, so the amount here in this example is slightly different. But the main point is that you are moving whatever got booked on RC non as realized exchange gain or loss. You are moving it to some RC that should cover this. In this video, we talked about foreign currency in common transaction types like donations and journal entries, and that it can be used freely and NetSuite will automatically translate it into your base currency. I showed you the transfer funds feature, how to move funds from one bank account to another in different currency. We explained what is currency revaluation and that it is automatic transaction done by NetSuite. We looked into gains and losses that are related to transmittal payment and explained that these need to be removed from IT Clear, as well as you need to remove other realized exchange differences from other RCs where they get booked. That is all for this video. If you have more questions, feel free to write to netsuite.help@crew.org or ask your finance leader. And also now you are ready to take the quiz about exchange differences and foreign currencies in NetSuite.